Imagine growing up with two powerful voices guiding your future. One encouraging you to chase security through education and employment, the other pushing you toward financial freedom through entrepreneurship and investing. This is the foundation of Robert T. Kiyosaki's best-selling book Rich Dad, Poor Dad. The story isn't merely about money. It's about the mindset that shapes how we understand, earn, and grow wealth. Through a compelling narrative of contrasting philosophies between two father figures, his biological father, the poor dad, and the father of his childhood best friend, the rich dad, Kiyosaki takes readers on a journey that unpacks the difference between working for money and having money work for you. His biological father, the poor dad, was well-educated, respected, and held a stable government job. He believed in traditional routes to success: study hard, get good grades, and find a secure job. In contrast, the rich dad had little formal education but possessed a deep understanding of money and wealth. He was a successful entrepreneur who believed that financial education, not academic degrees, was the key to prosperity. Kiyosaki grew up absorbing lessons from both, but ultimately found that the advice from his rich dad shaped his financial philosophy and future success. This juxtaposition of ideologies frames the entire book, making it a parable for anyone seeking to rethink their understanding of wealth and take control of their financial destiny. Let's explore this groundbreaking book in detail, expanding on its core ideas, lessons, and transformative mindset. Summary of Rich Dad, Poor Dad, approximate 2,000 words. Robert Kiyosaki begins Rich Dad, Poor Dad by recounting his early years in Hawaii, where he found himself grappling with conflicting messages about money. His poor dad, despite being intelligent and highly educated, struggled financially for most of his life. Meanwhile, his rich dad, who lacked a college degree, managed to build a successful empire through investments, businesses, and a deep understanding of how money works. From the outset, Kiyosaki makes it clear that the main difference between these two men was not the amount of money they earned, but the way they thought about money. This difference in mindset, Kiyosaki argues, is what separates the wealthy from the poor and middle class. One of the foundational themes in the book is that financial education is more important than academic education when it comes to achieving financial independence. Kiyosaki reflects on how traditional schooling teaches people to be employees, not owners or investors. Schools focus on reading, writing, and arithmetic, but not on how to manage or grow money. This, he argues, is why so many highly educated people still struggle financially. They were never taught how to make money work for them. Kiyosaki describes an early lesson from his rich dad, who told him, "The poor and the middle class work for money. The rich have money work for them." This simple yet powerful idea becomes the cornerstone of Kiyosaki's financial philosophy. Working for a paycheck might bring temporary security, but it doesn't lead to long-term wealth. The rich, by contrast, focus on acquiring assets, things that put money in their pocket, while minimizing liabilities, things that take money out. In another formative moment, Kiyosaki recalls asking Rich Dad how to make money. Rich Dad gave Kiyosaki and his friend Mike a job at one of his stores, paying them a meager wage. After several weeks of this low pay, Kiyosaki demanded better compensation or he'd quit. Rich Dad used this as a teaching moment. Life doesn't reward people for complaining or for working harder within the same constraints. Instead, people must learn to recognize opportunities, think creatively, and take calculated risks. That's how wealth is built. The book continually contrasts the behaviors and beliefs of the rich versus the poor/middle class. For instance, the poor dad avoids talking about money and views it as something to be earned and then spent. He says things like, "I can't afford it," which Kiyosaki explains shuts down critical thinking. In contrast, Rich Dad encourages asking, "How can I afford it?" A question that stimulates the brain and leads to opportunity. Kiyosaki also introduces a critical concept: the importance of building and owning assets. He distinguishes between assets and liabilities not just in the traditional accounting sense but in terms of cash flow. An asset, according to Kiyosaki, is anything that puts money in your pocket, like real estate, stocks, intellectual property, or a business. A liability is anything that takes money out, such as a mortgage, a car loan, or credit card debt. This redefinition of assets and liabilities is one of the book's most impactful ideas. Many people, for instance, consider their home an asset. But if your home costs you money every month in the form of a mortgage, maintenance, and taxes without generating income, then Kiyosaki classifies it as a liability. He challenges the reader to shift their thinking from net worth to cash flow literacy. Another significant lesson involves understanding the power of corporations and tax advantages. Kiyosaki argues that the rich use corporations as a tool to protect and grow wealth. Corporations provide legal and financial benefits, such as lower tax rates, the ability to write off expenses, and limited liability. While the average person earns income, pays taxes, and then spends what's left, the rich earn money through their corporations, spend on tax-deductible expenses, and pay taxes on what remains. This strategic use of business structures is rarely taught in school but plays a crucial role in wealth building. As the book progresses, Kiyosaki emphasizes the importance of learning through experience. He discourages the fear of making mistakes, which is often instilled in children through traditional education systems. In the real world, he says, failure is one of the best teachers. Rich Dad believed that financial intelligence is developed through trial, error, and reflection, not through textbooks alone. Kiyosaki also explores the emotional traps that keep people financially stagnant. Fear and desire. Fear of losing money prevents people from taking risks, while the desire for nice things often leads to poor financial decisions like buying liabilities or incurring debt. The rich learn to control these emotions. They take calculated risks, and when they lose money, they learn from it rather than retreating to the safety of employment. One of the more philosophical sections of the book deals with the idea that the biggest asset you have is your mind. If trained well, the mind can create immense wealth. If trained poorly, it can cause financial ruin. This reinforces Kiyosaki's point that education never stops, and that financial education is an ongoing, lifelong process. In terms of practical advice, Kiyosaki encourages readers to build strong financial habits and invest time in developing the following: accounting, understanding numbers, cash flow, and financial statements; investing and knowing how to evaluate opportunities and take strategic risks; markets, recognizing the forces that drive supply and demand; the law, leveraging tax advantages and protecting assets legally. He also highlights the importance of working to learn, not just working to earn. Early in his life, Kiyosaki took jobs not for the salary but for the skills and insights they offered, such as learning how to sell, manage people, and build systems. These skills later proved invaluable in his journey toward financial independence. Toward the end of the book, Kiyosaki warns readers against complacency. He argues that most people stay trapped in what he calls the rat race, a cycle of earning money, paying bills, and accumulating debt, because they lack the financial education and courage to break free. Escaping this trap requires a conscious decision to take control of your finances and adopt a different way of thinking. Kiyosaki also addresses common excuses people make: "I'm not good with numbers," "I don't have time," or "I'm too young/old." He insists that these are just mental barriers. The real obstacle, he suggests, is often fear or laziness disguised as justification. The final chapters of Rich Dad, Poor Dad offer a call to action. Kiyosaki challenges readers to invest in their financial education, start small, and build their confidence. He shares anecdotes of people who have begun with very little but, through persistence and creativity, became financially independent. He also reiterates the need to take responsibility for your financial life. No one else will do it for you. He doesn't offer get-rich-quick formulas or promise guaranteed wealth. Instead, he advocates for consistent learning, smart risk-taking, and a mindset focused on building long-term wealth. The real richness, he says, lies in having choices that come from financial freedom. At the age of 9, Kiyosaki and his best friend Mike were confused about money and how to become rich. After being teased by classmates for being poor, the boys decided they wanted to learn how to become wealthy. With the boldness of youth, they began trying to create wealth on their own. Their first attempt involved melting down toothpaste tubes made of lead and trying to mint counterfeit nickels. A creative but misguided venture that was quickly shut down by Mike's father. Rather than scolding them, Mike's dad, who would become the rich dad, recognized their initiative, and used the moment as an opportunity to begin their financial education. This moment marked the beginning of a profound mentorship. Kiyosaki explains that he had two father figures offering him conflicting views on money. His real dad, the poor dad, was well-educated with advanced degrees, a stable government job, and a strong belief in the traditional path of working hard, getting a good education, and securing a dependable job with benefits. In contrast, Mike's dad, the rich dad, did not finish 8th grade, yet became one of the wealthiest men in Hawaii. He believed that formal education was not enough, and that financial literacy was more important than academic credentials when it came to building wealth. When Robert asked Rich Dad to teach him how to become rich, the response was unconventional. Rich Dad agreed, but under one condition. Robert and Mike would have to work for him at one of his small grocery stores, earning just 10 cents an hour. The pay was intentionally low, far below the minimum wage, even for the 1950s, and it was meant to teach a lesson, not provide income. After a few weeks of working long hours for little pay, Robert became frustrated. He felt exploited and angry. He considered quitting, thinking it was unfair. When he voiced these complaints, Rich Dad saw an important teaching moment. Rich Dad explained that the experience of frustration, powerlessness, and the desire for more money were emotions that most adults felt, yet never questioned. These emotions, especially fear and greed, kept people trapped in a cycle where they worked hard to earn money, only to spend it all and then return to work to earn more. He described this cycle as the rat race. Most people, he said, work jobs they don't enjoy, simply to maintain a lifestyle based on expenses and debt. They are driven by fear. Fear of not having enough money. Fear of being poor. Fear of letting others down. This fear forces them into employment, and once they start receiving a paycheck, they develop an addiction to the sense of security it provides. The trap, Rich Dad explained, is not the job itself, it's the emotional reaction to money. When people work primarily out of fear or for the comfort that money supposedly provides, they lose the ability to think independently. They become slaves to money. They let money control them, rather than learning how to control money. The rich, on the other hand, do not work for money. They learn how to make money work for them. This distinction becomes the central lesson of the chapter. Rich Dad challenges the boys to begin thinking differently. He wants them to develop financial intelligence, not by attending traditional schools or getting high-paying jobs, but by learning how money operates, what it truly is, and how to make it grow. He stresses the importance of observation and critical thinking. The poor and middle class, he says, work for money and let their emotions, particularly fear and desire, rule their decisions. The rich observe these emotions and learn to detach from them. To reinforce this lesson, Rich Dad temporarily stops paying Robert and Mike altogether. Now working for free, the boys feel even more resentment, but Rich Dad watches closely to see how they respond. Eventually, Robert reaches a breaking point again and demands answers. Rich Dad then begins to explain that the real learning begins when one stops relying on a paycheck. Working for free forced the boys to open their eyes. They began to notice things others didn't, like how the store could make extra money by reselling outdated comics, or how people behaved when they were desperate for cash. These insights would never have occurred to them if they were focused only on how little they were being paid. Rich Dad wanted them to realize that financial opportunities are everywhere, but most people are blind to them because they're too busy worrying about money. Fear blocks perception. Only by stepping outside the cycle, by refusing to be controlled by the need for a paycheck, can one begin to see the bigger picture. This insight marks the beginning of financial intelligence. It's not just about making money. It's about thinking differently, seeing hidden patterns, and questioning assumptions. A key message in the chapter is about developing an entrepreneurial mindset. Rich Dad believes that working jobs for others teaches people to depend on someone else for their income and, by extension, their security. Instead of learning how to generate money independently, people become reliant on their employers. This dependency is dangerous because it limits freedom. The moment the paycheck stops, panic sets in. Rich Dad believes that by exposing oneself to risk and uncertainty early, such as working for free or building something from scratch, people become better equipped to understand how wealth is created and preserved. Another important element in the chapter is the concept of choice. Rich Dad emphasizes that people always have a choice. They can continue working for money and remain in the rat race, or they can begin to take control by investing in their own education, specifically financial education. This doesn't mean abandoning work or ignoring responsibility. Rather, it means being mindful of the motivation behind one's labor. Working out of fear, for instance, results in poor decisions. But working with a goal of learning and growth opens up new pathways to independence. Kiyosaki notes that the poor and middle class often allow money to become their master, while the rich learn how to master money. This mastery begins with awareness. Once you understand that emotions can be manipulated, that the promise of a paycheck can make people behave predictably, you can begin to question the system. Rich Dad points out that the moment people start depending on raises and promotions, they become afraid to challenge authority or take risks. They trade their freedom for comfort. In contrast, the rich seek opportunities where money is made through smart decisions, investments, or the use of systems. They look for ways to have money generate more money, through businesses, real estate, stocks, intellectual property, and other means. Instead of trading time for money, they trade ideas, assets, and systems for wealth. The underlying principle is leverage. The chapter closes with a reflection on the value of early education in financial literacy. Kiyosaki stresses how impactful it was for him to be exposed to Rich Dad's philosophy at such a young age. It shifted his understanding of what it meant to earn money, to work, and to succeed. By learning these lessons through experience, rather than in a traditional classroom, he developed the mindset necessary to eventually achieve financial independence. Despite being well-educated and intelligent, many people still struggle financially. Kiyosaki uses the contrast between his rich dad, his best friend's father, a savvy entrepreneur with little formal education, and his poor dad, his biological father, a highly educated government employee, to underscore the limitations of traditional schooling. His poor dad, although successful in the academic world and having earned multiple degrees, remained trapped in the cycle of working for money, living paycheck to paycheck, and never truly achieving financial independence. Rich Dad, on the other hand, had minimal formal education but was financially successful and understood how to make money work for him. This comparison sets the stage for the central argument of the chapter. The importance of financial literacy lies in understanding the difference between assets and liabilities. According to Kiyosaki, the single most important rule for getting rich is knowing what an asset is and what a liability is, and buying assets. This sounds deceptively simple, but he contends that most people, even well-educated professionals, do not grasp this concept properly. Financial struggle is often a symptom of this misunderstanding. An asset, as defined by Kiyosaki, is anything that puts money in your pocket. A liability, conversely, is anything that takes money out of your pocket. This is a significant departure from the definitions taught in traditional accounting and financial courses, where assets are usually described as anything you own and liabilities as anything you owe. Kiyosaki's definition focuses not on ownership or debt per se, but on the cash flow that results from the item. In other words, the critical factor is not whether something is listed on a balance sheet under assets, but whether it actually contributes to your income. To illustrate this, Kiyosaki uses the example of a house. Most people think of their house as their greatest asset. It's where they live, they have invested significant money in it, and it often represents their largest single purchase. However, from Kiyosaki's perspective, a personal residence is actually a liability. Why? Because it doesn't generate income. Instead, it demands money in the form of mortgage payments, property taxes, maintenance costs, and so on. Even if the house appreciates in value over time, during the period of ownership it is an ongoing expense. Unless it's a rental property that brings in consistent income greater than its expenses, it is not an asset in Kiyosaki's framework. This example challenges readers to reevaluate their financial assumptions. Many people have been conditioned to believe that acquiring a home is a sign of financial stability and success. But if that home is not generating income, and instead drains money every month, then it's not helping build wealth. Kiyosaki emphasizes that real wealth comes from assets that generate cash flow. These include businesses that do not require your presence, income-generating real estate, stocks that pay dividends, bonds, and royalties from intellectual property. The goal, he argues, should be to build a portfolio of these income-generating assets until the income they produce exceeds your expenses. at which point you are financially free. Kiyosaki critiques the traditional path of working hard, saving money, buying a house, and investing in a diversified portfolio of stocks and mutual funds. This path, he argues, often leads to frustration and disillusionment. He points out that inflation eats away at savings, housing markets can be unpredictable, and blindly investing in stocks without understanding them can be risky. More importantly, this strategy usually keeps people locked into the rat race, working to pay bills, maintain their lifestyle, and hope they have enough left over for retirement. A central theme in the chapter is the importance of learning how money works, not just earning it. Most people spend their lives learning how to work for money, but they never learn how to make money work for them. This is the core of financial literacy. Kiyosaki argues that schools focus on academic and professional education but completely neglect financial education. As a result, even high-income earners can struggle financially because they don't know how to manage, invest, or grow their money. This lack of financial literacy also leads many people into the trap of increasing their expenses as their income grows. They get a raise and immediately upgrade their lifestyle, buying a bigger house, a new car, or taking expensive vacations. This behavior creates a cycle where liabilities increase with income, leaving little room for building assets. In fact, the more they earn, the more they owe, keeping them perpetually dependent on their paycheck. Kiyosaki calls this the rat race, a term meant to describe the endless, unfulfilling cycle of earning and spending without real financial progress. One of the most powerful aspects of the chapter is Kiyosaki's insistence that financial success is not about how much money you make, but about how much you keep, and how effectively you make it work for you. He writes that someone earning $30,000 a year who invests wisely in income-generating assets can potentially become financially independent sooner than someone earning $300,000 a year who spends most of it on liabilities. Kiyosaki also explains that financial literacy is not just about technical knowledge, but also about mindset. Rich Dad taught him to view every dollar as an employee. Every dollar should be put to work to earn more dollars. The goal is to build a team of financial employees, your assets, that work for you, so that eventually you don't have to work for money at all. This shift in mindset, from working for money to making money work for you, is perhaps the most significant takeaway of the chapter. He provides a diagram showing how income flows through the balance sheet of the financially literate versus the financially ignorant. For the financially literate, income is used to buy assets which then generate more income. For the financially uneducated, income goes toward expenses and liabilities with little or no asset accumulation. This simple but powerful diagram encapsulates the essence of financial literacy. Additionally, Kiyosaki touches on the role of fear and desire in financial decision-making. He argues that most people are driven by fear of not having enough money and the desire for material possessions. These emotions lead them to make poor financial choices, working jobs they don't enjoy, spending more than they earn, and accumulating liabilities that don't bring long-term benefit. Financial literacy, in contrast, provides the tools to overcome these emotional traps by helping individuals make informed, rational decisions based on long-term goals rather than short-term gratification. The chapter also serves as a call to action, particularly for parents and educators. Kiyosaki urges readers to recognize that if they want their children to be financially successful, they must teach them about money, because schools likely won't. He stresses the importance of learning how to read financial statements, understanding how income flows, and recognizing the difference between good debt, debt used to acquire assets, and bad debt, debt used to acquire liabilities. By the end of the chapter, it becomes clear that Kiyosaki's vision of financial literacy extends far beyond budgeting or saving. It encompasses an entirely different way of thinking about money, one that emphasizes ownership, control, and strategic investment. This is a form of empowerment. When individuals understand how money works, they are better equipped to make choices that serve their long-term interests, rather than being at the mercy of employers, markets, or government programs. Chapter 3 of Robert Kiyosaki's Rich Dad, Poor Dad, titled Mind Your Own Business, represents a pivotal shift in the reader's understanding of financial independence and long-term wealth building. Kiyosaki's central message here is deceptively simple yet deeply transformative. While you may work for someone else, never forget to also work for yourself. In practical terms, this means you must always focus on building your asset column, even while earning a salary or working a traditional job. This chapter fundamentally challenges the conventional wisdom around employment, income, and success, urging readers to think beyond their job titles and paychecks and to embrace the mindset of wealth creation through ownership and investment. Kiyosaki begins the chapter by drawing a clear distinction between his two dads, the rich dad and the poor dad, in how they viewed work and money. The poor dad, representing the traditional, educated, middle-class mindset, believed in job security, stable income, and working up the corporate ladder. He viewed the job as the source of financial well-being, advising his son to study hard and get a good job with benefits. The rich dad, in contrast, believed in working to learn and, more importantly, in building assets. His philosophy emphasized that while employment may be necessary, it should not distract you from your personal financial growth. Rather than devoting one's entire life to building someone else's business or chasing promotions, one should always be working on their own business on the side. And by business, Kiyosaki means the building of personal assets. The author clarifies that minding your own business does not necessarily mean quitting your job or starting a traditional brick-and-mortar company. Rather, it means understanding the difference between your profession and your business. Your profession is your day job, the activity that earns you a paycheck. Your business, on the other hand, is what you invest in and build to create long-term wealth and financial independence. The danger lies in getting so caught up in your job and career that you forget to cultivate your personal wealth. This is a mistake many people make. They work for decades, believing that raises and promotions will secure their futures, only to find later in life that they are still financially dependent on their salaries or pensions. One of the core ideas in this chapter is the concept of the asset column. Kiyosaki explains that wealthy individuals focus on building assets, things that generate income and grow in value over time. These can include rental real estate, stocks, bonds, intellectual property, royalties, and business ownership. In contrast, the poor and middle class tend to accumulate liabilities that they mistakenly believe are assets, such as personal homes, cars, or luxury goods. These liabilities often drain money from your pocket through maintenance costs, taxes, or depreciation. According to Kiyosaki, the key to financial freedom is to focus relentlessly on building your asset column. No matter what your profession is, whether you're a doctor, teacher, mechanic, or lawyer, you should dedicate a portion of your time, energy, and resources to acquiring assets. This requires discipline and long-term thinking. It may mean buying real estate that generates rental income, investing in dividend-yielding stocks, creating a side hustle that grows into a small business, or acquiring intellectual property such as books, patents, or online content that earns passive income. Kiyosaki warns against the trap of lifestyle inflation. Many people, when they receive a raise or promotion, immediately increase their spending to match their new income, buying a bigger house, a nicer car, or indulging in expensive vacations. This behavior, though it may provide temporary satisfaction, does nothing to improve their long-term financial condition. In fact, it often increases their liabilities and monthly expenses, locking them deeper into the cycle of paycheck dependence. This is the rat race that Kiyosaki speaks of, a never-ending loop of earning and spending, with little to no focus on asset accumulation. To mind your own business, then, means living beneath your means and diverting the surplus into investments that build wealth over time. It means resisting the temptation to look rich in favor of becoming rich. Kiyosaki points out that many wealthy individuals live modestly, driving used cars and living in homes well below what they could afford, not because they're cheap, but because they understand the power of compounding and the importance of financial independence. They know that every dollar spent on liabilities is a dollar that could have been invested into their asset column. Another important aspect Kiyosaki highlights is financial literacy. To successfully build your asset column, you need to understand basic accounting and finance principles. You must be able to distinguish between assets and liabilities, understand cash flow, and recognize good investment opportunities. This knowledge isn't typically taught in schools, which is why so many people, even those with high incomes, struggle financially. The education system trains people to be employees, not investors or entrepreneurs. Kiyosaki argues that individuals must take responsibility for their own financial education. Read books, attend seminars, find mentors, and study how money works. The more financially literate you become, the better decisions you can make about your investments and your future. Kiyosaki also makes an important point about taxes. He explains that the rich understand the tax code and use it to their advantage, often through corporate structures, investments, and legal deductions. By contrast, the poor and middle class pay the highest percentage of their income in taxes because they earn wages. Wages are taxed at the highest rates, whereas business and investment income often benefit from favorable tax treatment. This is another reason why it's critical to build your own business and assets. It allows for greater control over how and when you earn income, and how much you keep after taxes. Throughout the chapter, Kiyosaki reiterates that job security is not the same as financial security. A job can disappear at any moment due to layoffs, economic downturns, or automation. Your assets, on the other hand, continue to generate income whether you're actively working or not. This is the essence of financial independence. Having enough passive income from assets to cover your expenses without relying on a paycheck. It grants freedom, flexibility, and the power to make choices based on desire rather than necessity. Kiyosaki shares stories of individuals who made the shift from employee mindset to investor mindset. These stories illustrate that it's never too late to start building your asset column. The journey may begin with small steps, saving to buy a single stock or a modest rental property. But with consistency and reinvestment, these small beginnings can grow into significant wealth. The key is to start now, no matter where you are financially, and to make asset building a lifelong priority. He also emphasizes the importance of keeping your daytime job while you build your personal business. This is not about abandoning responsibilities or making reckless leaps. It's about using your job to fund your investments, learn valuable skills, and give yourself the financial stability to take calculated risks. Think of your job as a tool, not a destination. Work hard at it, but always be planning for the day when your assets generate more income than your salary. The title of the chapter, Mind Your Own Business, is a clever double entendre. On one level, it's a call for personal responsibility. Don't worry about what others are doing. Focus on your own financial growth. On another level, it's a literal instruction to build and mind your own business, a source of income that you own and control separate from your employer. This dual meaning encapsulates the chapter's wisdom. You must take ownership of your financial future by actively participating in its creation. Ultimately, Kiyosaki's message in this chapter is both empowering and demanding. It empowers readers by showing them that they are not trapped by their jobs or salaries. With discipline, education, and effort, anyone can build wealth. But it also demands a shift in thinking and behavior. It requires saying no to short-term gratification, embracing risk and responsibility, and committing to lifelong learning. The rich don't evade taxes illegally. Instead, they avoid them legally. They do this primarily through a deep understanding of how corporations work and how tax laws are written. To fully grasp the argument, however, it is necessary to examine the history of taxation, the purpose it initially served, how it evolved over time, and how corporations have been structured to protect the wealth of their owners. The origins of taxes. Taxation, in some form or another, has existed for thousands of years. In ancient civilizations such as Mesopotamia, Egypt, and Rome, taxes were levied on crops, livestock, and labor. These early systems were primitive and often exploitative, used by rulers to fund their armies, build infrastructure, and enrich the state. However, taxes in these eras were primarily imposed on the working classes or conquered peoples, not on the elite. This theme, that the burden of taxation falls disproportionately on those without power, remains central to Kiyosaki's discussion. Fast-forwarding to the modern era, income tax, as we know, it was not always a permanent fixture. In the United States, the federal income tax was first introduced during the Civil War to fund the Union's war effort, but it was later repealed. It wasn't until the 16th Amendment was ratified in 1913 that income tax became a permanent part of the American economic system. It is important to note that when income tax was first introduced, it was promoted as a tax on the wealthy, the top 1% of earners. The public, particularly the middle and lower classes, supported it because they believed it would reduce inequality. However, this original promise quickly eroded. Over time, the tax net expanded. The middle class became the primary source of tax revenue, not the wealthy. This shift occurred gradually but methodically, as more people entered the workforce, and governments needed increasing revenue to fund social programs, wars, and infrastructure. The rich, meanwhile, learned how to shelter their money by using legal entities like corporations. The invention and evolution of corporations. The corporation is one of the most powerful inventions of the modern financial world. It is a legal entity, separate from its owners, that can own property, enter contracts, and, most importantly, be taxed separately. Corporations have existed since the Renaissance, but they became widespread during the Industrial Revolution, when large-scale capital was needed to fund railroads, shipping lines, and manufacturing. For wealthy individuals, the corporation offered something revolutionary: protection. If a business failed, the personal assets of its owners were shielded. This principle of limited liability was a powerful incentive for entrepreneurship and investment. It also laid the groundwork for a massive legal and financial infrastructure that would allow the wealthy to avoid heavy taxation. Kiyosaki's rich dad understood that the true power of a corporation lies not just in its limited liability, but in the way it allows income to be categorized and taxed differently. The difference between earning money as an individual and earning it through a corporation is the key to understanding why the rich pay less in taxes. Legally, the tax advantage of corporations. The tax system is structured in such a way that individuals are taxed first and then spend what remains. For example, if you earn $100,000 in salary, the government takes its share, perhaps 30%, and you're left with $70,000 to pay your expenses. In contrast, corporations operate on a different principle. They earn money, deduct their expenses, and then pay taxes on what's left. This subtle but powerful distinction is one of the fundamental truths of financial literacy that Kiyosaki emphasizes. Let's say a corporation earns $100,000 in revenue. It can deduct business expenses, travel, equipment, salaries, even benefits, before calculating its taxable income. Only after those deductions does the corporation pay taxes. This means that much of the spending that an individual would pay for with post-tax dollars, such as transportation, meals, or even health insurance, can be paid with pre-tax dollars if structured through a corporation. This structure allows the wealthy to live well without necessarily increasing their personal taxable income. For example, a wealthy individual might own a corporation that pays for their car, travel, and cell phone, all as business expenses. These are not counted as personal income, and therefore they are not taxed in the same way. To someone unfamiliar with this system, it might appear as though the wealthy are avoiding taxes unfairly, but in reality, they are simply using the rules of the system to their benefit, rules that are available to anyone but taught to very few. The educational divide. Kiyosaki contrasts his rich dad and poor dad not just in terms of income, but in terms of financial education. His poor dad, who was highly educated in the traditional sense and worked for the government, believed in working hard, getting a good job, and paying taxes as a civic duty. He accepted the tax system as a given, never questioning its fairness or structure. His rich dad, by contrast, educated himself in the rules of money and taxation. He understood that the tax code is essentially a set of incentives, and that those who take the time to understand and use these incentives can legally reduce their tax burden. This difference in mindset is critical. The average person views the tax system as something static and unavoidable. The wealthy, however, view it as a game with rules, and if you learn the rules, you can win. Tax avoidance, as opposed to tax evasion, is entirely legal and, in many cases, encouraged by the government to promote certain behaviors, such as investing in real estate, creating jobs, or starting a business. Governments and incentives. One of the often overlooked aspects of tax policy is that it is not just a method for raising revenue, it's a tool for shaping economic behavior. Governments use tax incentives to encourage investment in certain areas. For example, tax credits are given for investing in renewable energy, providing affordable housing, or starting businesses in economically distressed areas. The wealthy, who typically have teams of accountants and financial advisors, are well-positioned to take advantage of these incentives. This is another area where the middle class and poor are at a disadvantage. Not because they lack intelligence, but because they lack access to financial education. They are taught to earn money through wages, pay their taxes, and save the rest. The wealthy, on the other hand, are taught to invest in assets and use corporations and legal structures to protect and grow their wealth. The legal loopholes. Kiyosaki is careful to emphasize that the rich are not breaking the law, they are using the law. Tax loopholes are often seen as underhanded, but they are simply the result of complex legislation written with various constituencies in mind. For instance, if a law is passed to promote real estate development, it may include provisions that allow developers to deduct certain expenses or defer capital gains taxes. A savvy investor will study the law and use it to their advantage. A less educated investor will either miss the opportunity or end up paying more than necessary. In this sense, tax law becomes a language, one that needs to be learned if you want to succeed in the financial world. The rich are fluent in it, while the poor and middle class often never even realize such a language exists. Kiyosaki's argument is that schools do not teach this financial literacy because they are focused on creating employees, not employers. As a result, the system perpetuates itself, with the wealthy staying wealthy and the rest of society shouldering the tax burden. The ethics of tax avoidance. A common criticism of this argument is that it seems to celebrate behavior that is perceived as selfish or unethical. Kiyosaki does not ignore this criticism, but he reframes it. He argues that the true ethical lapse is in failing to educate people on how the system works. If governments and educational institutions taught financial literacy, then more people could benefit from the same rules the rich use. Instead, a culture of shame is created around money, where asking questions about taxes, investing, or wealth is seen as greedy or impolite. This moral framing is crucial to the chapter's message. Kiyosaki is not advocating for tax evasion or unethical behavior. He is advocating for education, transparency, and personal responsibility. His view is that the system is not inherently unfair, it is simply complex. Those who learn how to navigate it can thrive. Those who don't are left at a disadvantage. The Rich Invent Money explores a powerful concept that lies at the heart of financial success: the ability to create opportunities through financial intelligence. This chapter delves into the mindset and actions that separate the financially successful from those who remain stuck in traditional thinking and conventional paths. Kiyosaki argues that wealth is not merely the result of working hard or saving diligently. It's about thinking differently, spotting or creating opportunities, and having the courage to take calculated risks. In essence, the rich don't simply work for money. They use their financial intelligence to invent money. To understand this idea, Kiyosaki begins by contrasting the experiences and lessons he received from his rich dad and his poor dad. His poor dad believed in the conventional route: get a good education, find a secure job, save money, and avoid risk. This is the formula most people are taught from a young age. It's a strategy that emphasizes safety and stability, which makes sense on the surface, but often leads to financial mediocrity. On the other hand, his rich dad took a very different approach. He believed that true wealth comes not from laboring for others, but from learning how money works and using that knowledge to make money work for you. The essence of this chapter is about empowerment through knowledge. Kiyosaki insists that financial intelligence is not necessarily about having a high IQ or being good with numbers. Instead, it's about developing a mindset that is open to possibilities, that sees challenges as opportunities, and that continually seeks to learn and grow in the realm of money and investing. He makes it clear that in the modern world, financial opportunities are abundant, but most people are not trained to see or seize them. They are stuck in the mindset of employees or consumers, not investors or creators. One of the key takeaways from this chapter is the idea that money can be created through ideas. This doesn't mean printing your own currency, but rather recognizing that by thinking creatively and using your knowledge, you can generate value that translates into income or wealth. The rich, according to Kiyosaki, are those who develop the skill of identifying underappreciated assets, undervalued opportunities, or inefficiencies in the market. They then apply their creativity and financial understanding to turn those into profitable ventures. Whether it's real estate, stocks, businesses, or intellectual property, the rich see assets everywhere, and they know how to make those assets generate income. Kiyosaki uses real-life examples to illustrate this point. He talks about how he and his friends learned to find value in places others overlooked. For example, they would look for real estate that was priced below market value or had some potential that others didn't see. Through education and research, they would recognize deals that could produce significant returns. The critical ingredient here is not money itself, but knowledge. It's the financial intelligence that allows someone to look at the same opportunity as everyone else but see something different, something valuable. This idea leads to another major theme of the chapter: risk and how it is perceived. Kiyosaki argues that most people avoid financial risks because they fear losing money. This fear is often rooted in a lack of financial education. When people don't understand how an investment works, or what the risks truly are, they perceive the entire endeavor as too dangerous. But the rich see risk differently. They understand that all investments carry some risk, but they also know that with proper education and due diligence, those risks can be mitigated. They know that knowledge reduces risk. More importantly, they know that taking no risk at all is itself a risk of remaining stuck, never growing wealth, and always being dependent on others for income. Creativity is another critical component of financial intelligence emphasized in this chapter. Kiyosaki explains that creativity is what enables people to come up with solutions that others wouldn't think of. When everyone sees a problem, the financially intelligent person sees a possibility. Creativity allows you to make money in situations where most people believe there is no money to be made. For example, a financially intelligent person might see a dilapidated building and envision a thriving business complex. Others might see only decay and cost, but through the lens of financial creativity, that building becomes an opportunity to invent wealth. The ability to see things differently, to imagine potential rather than simply accept reality, is what separates successful investors and entrepreneurs from the rest of the population. Another crucial element discussed in this chapter is decision-making. Informed decision-making is at the heart of financial intelligence. Kiyosaki stresses that making good financial decisions requires more than just luck or intuition. It requires a solid foundation of knowledge about the subject at hand. This is why he advocates for continuous learning and hands-on experience. He encourages readers to attend seminars, read books, network with knowledgeable people, and, most importantly, take action. Even small investments or entrepreneurial ventures can teach valuable lessons that build financial acumen. With each informed decision, whether it leads to success or failure, your financial intelligence grows. And as it grows, so does your ability to invent money. Kiyosaki also explores the concept of leveraging resources, another way in which the rich create money. Leveraging involves using other people's time, money, skills, or ideas to build wealth. A classic example is using borrowed money, debt, to invest in an asset that generates income greater than the cost of the loan. Most people fear debt and avoid it altogether, but the financially intelligent know how to use it strategically. Similarly, entrepreneurs build businesses not solely on their own effort, but by assembling teams of people with different skills and delegating responsibilities. This ability to leverage is a hallmark of wealth creation, and again, it stems from financial intelligence. The chapter doesn't suggest that this path is easy or risk-free. In fact, Kiyosaki acknowledges that mistakes are inevitable. But he argues that mistakes should not be feared, they should be embraced as part of the learning process. People who are afraid of failing often never take action, and as a result, never grow. On the other hand, those who are willing to take risks, make mistakes, and learn from them end up acquiring the wisdom and experience necessary to succeed. Kiyosaki emphasizes that he learned the most not when things went smoothly, but when he faced challenges or losses and had to adapt. This resilience and willingness to learn from failure is what allows financially intelligent individuals to recover and ultimately thrive. In tying the chapter together, Kiyosaki underscores that money follows ideas. If you have the knowledge, creativity, and courage to act, you can turn ideas into assets. And you don't need to have money to start. Many of the world's wealthiest individuals started with very little in terms of capital. What they had was a vision, a willingness to learn, and the determination to turn knowledge into action. This is why Kiyosaki says that the rich invent money. They don't wait for opportunities to come to them. They create opportunities through financial insight and strategic action. Finally, this chapter is a call to action. It encourages readers to stop thinking like employees who exchange time for money and start thinking like investors and entrepreneurs who create systems and assets that generate income. It's about shifting your mindset from scarcity to abundance, from fear to confidence. By developing financial intelligence, anyone can begin to see the world differently. Instead of only seeing bills, expenses, and jobs, you begin to see deals, investments, and opportunities. And once you develop this perspective, you're no longer at the mercy of economic forces. You become an active creator in your financial life. Robert Kiyosaki explores a profound and counterintuitive principle that reshapes the way we view employment and education. Work to learn. Don't work for money. At the heart of this chapter lies the idea that most people, consciously or unconsciously, get trapped in a cycle of working purely for a paycheck. This chapter challenges that conventional mindset and instead promotes working to acquire valuable life and business skills. Kiyosaki draws heavily on his own experiences and observations to argue that broadening one's abilities is far more beneficial in the long term than the pursuit of immediate income. To fully grasp the message of this chapter, we must first understand the psychological and societal forces that lead people to work primarily for money. From a young age, most individuals are taught to go to school, get good grades, and then find a secure job with benefits. This traditional route is praised as the responsible and stable path in life. Yet Kiyosaki contends that this system prepares people to become employees who are reliant on employers, rather than equipping them to be independent thinkers, entrepreneurs, or investors. Working for money often means falling into the so-called rat race, a never-ending cycle of earning, spending, and striving for the next promotion or raise without ever gaining true financial independence. Kiyosaki explains that when people chase after money alone, they usually remain in jobs that don't teach them much beyond what they already know. They settle into routines, become comfortable with what they do, and often avoid risks. Over time, this leads to specialization. While specialization may result in increased expertise and a stable income in a narrow field, it also limits opportunities for innovation, flexibility, and advancement beyond that particular niche. Specialists, he argues, are often at the mercy of economic shifts and technological changes that can make their specific skills obsolete or less valuable. This is where the concept of working to learn becomes vital. Instead of focusing solely on income, Kiyosaki advocates deliberately choosing jobs, roles, or even side projects that expose you to a wide range of skills. The goal is not immediate monetary gain, but rather long-term knowledge acquisition. For example, someone might take a job in sales not because they see themselves as a lifelong salesperson, but because they understand that sales is a fundamental skill in business, entrepreneurship, and even everyday life. Being able to sell, whether it's an idea, a product, or oneself, is invaluable. Similarly, learning marketing helps in understanding how to attract and retain customers, a key to success in virtually any venture. Kiyosaki makes the point that his rich dad, a friend's father who became his financial mentor, often advised him to take on jobs that would teach him something new, even if they paid less. His rich dad emphasized learning skills such as leadership, communication, investing, and strategic thinking, all of which are transferable and valuable in many contexts. By contrast, his poor dad, his biological father, a well-educated man with a steady government job, placed a higher emphasis on job security, promotions, and pensions. This difference in mindset made all the difference in how each man approached career development and financial planning. One of the core themes in this chapter is the distinction between being an employee and being an entrepreneur or investor. Employees typically trade time for money. Their earnings are usually limited by hours worked and the hierarchy of the organization they're in. Entrepreneurs and investors, on the other hand, leverage systems, people, and capital to generate income and wealth. They create value rather than simply executing tasks. However, becoming a successful entrepreneur or investor requires a broad base of knowledge, something that isn't usually taught in school or gained through a single job or profession. This is why Kiyosaki insists that acquiring a wide range of skills is essential. He draws attention to how individuals who are well-rounded, those who understand not just their own field, but also elements of finance, management, and marketing, are often more successful in creating and sustaining wealth. They are not easily replaceable because their value doesn't come from narrow technical know-how, but from their ability to see the bigger picture and adapt. Broad experience enables people to solve diverse problems, communicate across departments, and seize opportunities others may not even recognize. In the business world, this translates into tangible advantages. For instance, a graphic designer who understands basic marketing principles will produce more effective content than one who does not. A software engineer with a grasp of sales can better tailor their work to client needs. A restaurant owner who understands accounting, inventory, customer service, and leadership will run a smoother and more profitable operation. Each of these individuals becomes more resilient and valuable because they've taken the time to learn beyond their initial expertise. Kiyosaki also delves into how fear and comfort zones hold people back from pursuing learning over earning. Many people don't want to step into unfamiliar territory, fearing failure or a temporary drop in income. But in doing so, they sacrifice long-term growth for short-term security. This can lead to stagnation. The irony is that the same people who seek stability by clinging to a single job may find themselves in trouble when that job becomes redundant, the company downsizes, or new technology changes the landscape. In contrast, someone who has a diversified skill set can pivot more easily and find new ways to earn, adapt, or even create their own opportunities. To reinforce his message, Kiyosaki recounts stories of individuals who made deliberate career moves to expand their horizons. He talks about people who took roles in sales departments, even when they had no interest in becoming salespeople, just to understand customer psychology and the dynamics of business transactions. He himself once took a job at Xerox, a company known for its rigorous sales training, to learn how to overcome rejection and influence people. Though he had no intention of staying in sales forever, the experience shaped his confidence and helped him build his future ventures. Another important point in this chapter is the importance of understanding money, not just earning it. Kiyosaki emphasizes that financial literacy is crucial, and that includes learning about investing, taxes, cash flow, and assets versus liabilities. Working to learn means taking time to educate oneself on how money works. It's not just about having a high-paying job, but about knowing how to make that money work for you through smart investments and financial planning. Many high-income professionals still struggle financially because they lack these fundamental understandings. Furthermore, Kiyosaki argues that a job should be seen as a stepping stone, not an endpoint. Each job or role can be an opportunity to gain insight, build networks, and experiment with new ideas. This mindset helps cultivate an entrepreneurial attitude, where every experience adds to your toolbox. When you work for learning rather than just for money, you approach your career with curiosity, resilience, and a sense of strategic purpose. You no longer see yourself as just an employee, but as someone who is constantly growing and preparing for larger goals. This philosophy has implications for how we define success. Rather than seeing success purely in terms of salary or job title, Kiyosaki encourages evaluating success based on personal development, freedom, and the ability to create and sustain wealth over time. Working to learn may not always look glamorous at first. It might involve lower pay, more hours, or unfamiliar tasks. But over time, it builds a foundation that leads to greater autonomy and financial strength. In broader terms, Kiyosaki's approach challenges the structure of modern education and employment. It questions whether traditional schooling actually prepares students for the real world or simply trains them to be obedient workers. Schools often emphasize memorization, compliance, and narrow specialization. But the world increasingly rewards those who can think critically, adapt quickly, and understand complex systems. These are not traits that can be developed without deliberate effort and experience. Hence, Kiyosaki suggests that real education begins after formal schooling ends, and that the workplace can be the best classroom if approached with the right mindset. For younger readers or those early in their careers, the chapter offers valuable guidance. Don't be afraid to take risks, explore new industries, and work outside your comfort zone. Seek out mentors, learn from setbacks, and always ask yourself not just, what am I earning? But also, what am I learning? For more experienced professionals, the lesson is to stay curious and keep evolving. Even if you've been in the same role for years, there's always more to learn. Be it leadership, investing, or digital skills. that can transform your career trajectory. Ultimately, the message of work to learn, don't work for money, is about empowerment. When you focus on learning, you take control of your development. You become less dependent on employers, more confident in your abilities, and more capable of recognizing and seizing opportunities. Money, then, becomes a byproduct of your growth rather than the sole reason for your work. It's a shift from passive income earning to active wealth creation. In Rich Dad, Poor Dad, Chapter 7 titled Overcoming Obstacles represents one of the most powerful and revealing parts of Robert Kiyosaki's financial philosophy. While the earlier chapters provide practical advice on financial literacy and wealth-building tools, this chapter shifts focus to something more abstract but no less important: the emotional and psychological barriers that keep people from becoming wealthy. Kiyosaki argues that no matter how intelligent, talented, or financially literate a person is, they may still remain poor or middle class if they cannot overcome the internal obstacles that sabotage their financial progress. These obstacles are often hidden deep within our psyche, embedded in our upbringing, social conditioning, and life experiences. Kiyosaki identifies 5 major internal enemies that must be defeated to achieve financial freedom: fear, cynicism, laziness, bad habits, and arrogance. Each of these enemies operates in a subtle and often unconscious manner, yet each can be powerful enough to destroy dreams, drain motivation, and paralyze decision-making. According to Kiyosaki, recognizing and confronting these barriers is just as important as understanding how to invest, save, or create passive income. Without the right mindset, no amount of external knowledge will lead to lasting financial success. One of the most pervasive and powerful emotional blocks to wealth is fear. Kiyosaki begins the discussion by acknowledging that fear is a natural human emotion, and it is not necessarily wrong to feel it. The problem arises when fear is allowed to dominate our lives and decisions. He argues that the fear of losing money is what holds back most people from taking risks or pursuing opportunities. Interestingly, he notes that even rich people experience fear, but the difference lies in how they respond to it. Instead of being paralyzed by fear, wealthy individuals use it as a motivator to learn more, take calculated risks, and persevere through setbacks. For many people, the fear of losing money is tied to a deeper fear of failure or embarrassment. Society often conditions us to associate financial loss with personal inadequacy. This mindset leads individuals to seek security rather than opportunity, choosing stable jobs over entrepreneurial ventures, or sticking to traditional paths like saving in banks rather than learning about investing. Kiyosaki's Rich Dad taught him that failure is not something to be feared but embraced as a necessary part of the learning process. In his view, failure is a stepping stone to success, a classroom in which valuable lessons are learned. The poor and middle class, on the other hand, tend to view failure as a source of shame, something to be avoided at all costs. This difference in perception becomes a major determinant of one's financial future. Connected to fear is cynicism, another major mental obstacle that undermines people's financial aspirations. Cynicism takes the form of self-doubt, skepticism about opportunities, and a tendency to listen to negative opinions from others. Kiyosaki emphasizes that cynicism often manifests in internal dialogues, the little voice inside one's head that says, "This won't work," or "What if I lose everything?" More damaging is external cynicism, especially from friends, family, or colleagues who discourage ambition, usually out of their own fears or lack of understanding. Kiyosaki points out that cynics often miss opportunities not because the opportunities were bad, but because their own negative thinking blinds them to possibilities. For instance, many people might look at an investment opportunity and immediately think of everything that could go wrong instead of considering what could go right. This mindset shuts down curiosity and initiative. To overcome cynicism, Kiyosaki recommends developing a strong sense of purpose, educating oneself, and surrounding oneself with positive, forward-thinking individuals. A resilient mindset does not ignore risks. It simply refuses to be governed by them. Laziness, though less obvious, is another barrier to wealth that Kiyosaki explores. He challenges the common perception of laziness as merely doing nothing or being idle. In his view, laziness can be very subtle and disguised as busyness. People often fill their schedules with tasks, errands, and obligations to avoid dealing with the things that really matter, like their financial future. Kiyosaki provides an example of individuals who claim they are too busy to look into investment opportunities, read about personal finance, or plan their retirement. In truth, this busyness masks a kind of mental or emotional laziness, a reluctance to deal with uncomfortable realities or to put in the effort required to change one's circumstances. The antidote to laziness, according to Kiyosaki, is a strong sense of purpose and a clear vision of one's goals. When a person is passionate about their financial goals, whether it's achieving independence, supporting a family, or making a difference in the world, they are far more likely to take action and persevere through difficulties. Purpose fuels discipline, and discipline counters laziness. Without a strong why, people are easily distracted and remain stuck in routines that feel productive but lead nowhere financially. Another significant obstacle discussed in this chapter is bad habits. Kiyosaki argues that our financial habits, how we spend, save, invest, and manage money, have a greater impact on our wealth than income alone. People can earn large salaries and still remain broke if they have poor habits. One of the most damaging habits is the tendency to pay everyone else first, the government, creditors, bills, before paying oneself. Kiyosaki's rich dad taught him the principle of pay yourself first, which means setting aside savings or investment capital before paying for other expenses. This habit trains the mind to prioritize financial growth and forces one to be more creative and resourceful in managing remaining funds. Other bad habits include impulsive spending, lack of budgeting, procrastination, and avoiding financial education. These habits often develop early in life and are reinforced by cultural norms, advertising, and peer behavior. To replace bad habits with good ones, Kiyosaki recommends self-awareness, discipline, and regular review of one's financial goals. He also suggests forming new habits such as reading financial books, tracking income and expenses, and networking with financially successful people. Changing habits is not easy, but it is essential for long-term financial health. The final obstacle Kiyosaki discusses is arrogance. While fear and laziness are often passive in nature, arrogance is active and aggressive. It manifests as the belief that one already knows enough, and thus closes the mind to new information or alternative viewpoints. Arrogance keeps people from asking questions, seeking help, or learning from others. In financial matters, arrogance can lead to costly mistakes, investing in things one doesn't understand, refusing to admit errors, or ignoring advice from those with more experience. Kiyosaki is careful to distinguish between confidence and arrogance. Confidence is built on knowledge and humility, while arrogance is built on ignorance and pride. The key to overcoming arrogance is to adopt a mindset of lifelong learning. No matter how successful or educated one becomes, there is always more to learn, especially in a dynamic and complex field like personal finance. Kiyosaki himself admits to making mistakes but emphasizes the importance of learning from them. He encourages readers to be open, curious, and humble, recognizing that wisdom often comes from unexpected sources. Together, these 5 obstacles, fear, cynicism, laziness, bad habits, and arrogance, form a formidable set of challenges on the path to wealth. Yet Kiyosaki's message is ultimately optimistic. He does not present these obstacles as insurmountable, but rather as natural parts of the human experience that can be understood, managed, and overcome. He invites readers to reflect honestly on which of these barriers they struggle with the most and to take proactive steps toward personal growth. A recurring theme in this chapter is the importance of emotional intelligence in financial success. While traditional education emphasizes IQ, measured by test scores and academic achievement, Kiyosaki argues that EQ, or emotional intelligence, is just as critical, if not more so. Managing emotions like fear, greed, and pride can be the deciding factor between success and failure. Emotional discipline allows people to stick with a long-term financial plan, resist impulsive decisions, and remain focused during times of uncertainty. In the broader context of Rich Dad, Poor Dad, Chapter 7 serves as a crucial bridge between knowledge and action. It is not enough to understand assets and liabilities, real estate, or investing principles. The real challenge lies in applying that knowledge consistently and courageously, especially when faced with setbacks, criticism, or temptation. This chapter reminds readers that the greatest obstacles are often not external, but internal, and overcoming them is the key to unlocking lasting wealth and freedom. In Chapter 8 of Your Money or Your Life, titled Getting Started, the authors take a decisive turn from theory to practice. Up to this point, the book has spent considerable time examining the nature of money, the psychological relationship people develop with their earnings and consumption, and the consequences of unconscious financial habits. Now, the authors bring readers to the critical pivot: action. It is here, in Chapter 8, that the journey toward financial independence truly begins, not just as an idea or dream but as a lived, measurable transformation. This chapter is not just a list of to-dos. It's a guided reorientation of mindset, habits, and long-standing assumptions that need to be questioned or discarded altogether. From passive living to active engagement. A central theme running through Chapter 8 is the transition from passivity to intentionality. Many people drift through their financial lives, reacting to needs and desires as they arise, often driven by cultural norms, advertising, or social pressures. They might save sporadically, invest without understanding, or spend without reflection. In contrast, the authors emphasize that financial independence requires a level of engagement and self-awareness that many people have not practiced before. To get started in this context means beginning to take full responsibility for your financial life. This doesn't imply blame for past decisions, but rather the empowerment to shape your future. The first step, then, is a shift in mindset from money happening to you to money becoming something you actively manage, direct, and understand. This shift is neither small nor automatic. It demands a reckoning with your beliefs about money, your fears, your hopes, and your habits. Facing the numbers, clarity as power. The authors are adamant that true transformation begins with clarity. This means knowing, in no uncertain terms, how much money is coming in, how much is going out, and exactly where it's going. Chapter 8 introduces the foundational practice of tracking every cent that flows in or out of your life. For many, this exercise can be jarring. People often avoid looking too closely at their financial habits because of shame, anxiety, or simple inertia. But the book insists that if you don't know where your money is going, you have no way of redirecting it toward the things that truly matter to you. The act of tracking spending, every purchase, no matter how small, is both a tool and a psychological intervention. It breaks through denial. It reintroduces agency. It reveals patterns you didn't know existed. And importantly, it helps to dissolve the myth that financial problems are simply about not earning enough. Often, people find that even modest incomes can support meaningful lives when money is used consciously and in alignment with values. This process, as described in the chapter, doesn't have to be complicated. The authors advocate for simple systems: pen and paper, envelopes, or a basic spreadsheet. What matters is the consistency of tracking, not the method. By bringing spending out of the shadows and into the light, readers begin to reclaim control. Money as life energy. A powerful and unique concept introduced earlier in the book and emphasized again here is the idea that money represents life energy. This is more than just a metaphor. The authors argue that money is essentially a condensed form of the time and energy you expend to earn it. When you spend money, you're spending not just dollars but hours of your life. Chapter 8 encourages readers to calculate their real hourly wage, which goes beyond the paycheck. It includes commute time, work-related expenses, decompressing after work, and any other hidden costs. Once this number is known, it becomes the metric through which spending is evaluated. For instance, if you make $15 per hour after expenses and taxes, then spending $30 on a dinner means exchanging 2 hours of your life. This recalibration changes everything. Suddenly, expenditures are no longer just monetary, they are existential. You begin to ask, is this meal, gadget, or service worth the hours of life I spent to pay for it? This question becomes a litmus test for intentionality. It's not about depriving yourself, but about aligning spending with values. If a dinner out brings true joy and connection, it may be worth every minute. If it's mindless or habitual, it may not be. Values-based spending. Another cornerstone of Chapter 8 is the encouragement to align financial behavior with personal values. This is a radical shift from the consumerist norm, which often equates spending with happiness. The authors invite readers to define what truly matters to them, not according to advertisements or social comparisons, but based on internal truth. Many people, upon reflection, find that they are spending significant amounts of money on things that don't actually improve their lives. Chapter 8 asks the reader to confront this dissonance. By connecting each expenditure with the corresponding amount of life energy, and then asking whether that expenditure brought satisfaction proportional to the cost, people begin to develop a clearer, more conscious relationship with money. This process requires honesty. It might reveal that certain recurring expenses, daily coffee runs, streaming subscriptions, gym memberships, online shopping, are not bringing proportional joy or value. But this isn't about guilt. The goal isn't austerity but awareness. The point is to spend less on what doesn't matter so that you have more time, freedom, and resources to spend on what does. Developing a new relationship with work. Chapter 8 also prompts a reevaluation of work. For many, work is the central organizing principle of life. It dictates where we live, how we spend our time, and how much energy we have for other pursuits. But what if work wasn't the center? What if work was one part of life, a means to an end, rather than the end itself? This chapter starts to plant the seeds for this kind of reimagining. As people begin to spend more intentionally and reduce waste, they often realize they need less money than they thought. That means they don't have to sell as much of their life energy to earn money. Over time, this opens the door to downshifting, changing careers, or pursuing part-time work. But these outcomes start here, with the decision to see money as a tool for freedom rather than a treadmill that must be run endlessly. Small wins, big momentum. Importantly, the chapter doesn't advocate for massive, overnight changes. Instead, it encourages small, sustainable steps. This might mean simply tracking spending for a week, or evaluating one purchase a day for its true value, or having one conversation with a partner or friend about financial goals. These small steps build momentum. Each action reinforces a sense of agency, a belief that change is possible, and a growing clarity about what matters most. The book recognizes that financial independence is a long journey, especially for those starting with debt, low income, or financial instability. But Chapter 8 assures readers that the journey is possible for almost anyone. The first step is not paying off all debt or becoming an expert investor. The first step is waking up to your patterns, your numbers, your beliefs. Money and mindfulness. There is a strong undercurrent of mindfulness in this chapter. In a sense, the authors are advocating for a kind of financial meditation, observing your spending without judgment, noticing what arises, and cultivating a more conscious relationship with money. This practice is not always comfortable, but it is deeply rewarding. Mindfulness allows people to notice not only what they're spending, but why. Are they spending out of boredom, stress, fear, trying to impress others, trying to avoid difficult emotions? When these underlying motivations are brought into awareness, people can begin to address the root causes, rather than trying to fix things through more spending. Breaking the cultural trance. Finally, Chapter 8 speaks to the cultural dimensions of personal finance. We live in a society that equates success with consumption, that praises busyness and overwork, and that often stigmatizes simplicity or frugality. Getting started on the path to financial independence means breaking out of this trance. It means choosing to live by your own values rather than society's expectations. This can be a lonely or even scary decision. Friends and family may not understand. You may feel like you're swimming upstream, but the book reassures readers that they are not alone. There is a growing community of people choosing intentionality over excess, freedom over conformity. Rich Dad, Poor Dad by Robert T. Kiyosaki offers a powerful and thought-provoking perspective on financial education, challenging conventional beliefs about money, work, and success. Through the contrasting lessons of two father figures, his highly educated but financially struggling biological father, the poor dad, and the financially savvy, entrepreneurial father of his best friend, the rich dad, Kiyosaki delivers a compelling argument for the importance of financial literacy, independence, and strategic thinking in achieving true wealth. At its core, The book emphasizes that traditional education often fails to equip individuals with the knowledge necessary to manage money effectively. While schools teach students how to work for money, they rarely teach them how to make money work for them. This is a central theme that runs throughout the book, highlighting the limitations of relying solely on academic achievements and salary jobs to secure financial freedom. According to Kiyosaki, true wealth lies not in high income but in building and acquiring assets that generate passive income over time. One of the book's most enduring lessons is the difference between assets and liabilities. Kiyosaki insists that a financially intelligent person must understand this distinction and focus on acquiring assets, such as real estate, stocks, businesses, and intellectual property, that appreciate in value or produce consistent income. In contrast, many people mistakenly acquire liabilities, thinking they are assets. For example, buying an expensive house or car on credit can seem like an investment, but in reality, these often drain resources rather than build wealth. The book also promotes an entrepreneurial mindset. Rich Dad teaches that working for others limits your potential, while creating your own ventures opens the door to financial growth and independence. He encourages readers to take calculated risks, learn from failures, and be proactive in seeking out opportunities for financial growth. This entrepreneurial spirit is tied to the broader idea that wealth is more about mindset and knowledge than about income levels or job titles. Another key takeaway is the importance of continual learning. Kiyosaki advocates for financial education outside of formal institutions, learning through experience, mentorship, books, seminars, and even mistakes. He stresses the need for self-discipline, long-term vision, and the courage to step outside of one's comfort zone in pursuit of financial success. Ultimately, Rich Dad, Poor Dad is more than just a guide to wealth. It's a call to rethink how we approach money, work, and life. It urges readers to break away from the rat race, challenge societal norms, and take control of their financial destinies. While some critics argue that the book oversimplifies certain financial concepts, its value lies in its ability to inspire a shift in perspective, especially for those who have never been taught how money really works.